The paradise that politicians promised is crumbling before our eyes. Governor Josh Green watched as Maui's condo market seized up overnight. Buyers vanished, and deals collapsed faster than anyone thought possible. What started as whispers of a correction has exploded into a full-scale crisis that's rewriting the rules of Hawaiian real estate. Behind the tropical facade, a financial earthquake is shaking the foundations of island living, and the governor's desperate scramble to contain the damage reveals just how fragile this market really was. When the numbers started flooding into the governor's office, the panic was immediate. Condo sales had plummeted by margins that made seasoned analysts double-check their calculations. Properties that once attracted bidding wars now sit empty for months. Their asking prices slashed again and again as sellers chase a market that keeps falling. The dream of owning a piece of paradise has turned into a nightmare for thousands of families who bought at the peak, watching their equity evaporate with each passing week. The warning signs were there, but nobody wanted to believe them. Local real estate agents had whispered about slower showings and longer days on market, but the official line remained optimistic. Tourism was strong, migration patterns looked favorable, and the governor's public statements painted a picture of sustained growth. Behind closed doors, however, emergency meetings were already underway as the administration grappled with data that contradicted every rosy projection they'd made to voters and investors. What makes this collapse so devastating isn't just the speed, it's the scale. Entire buildings that developers rushed to market during the boom years now stand as monuments to miscalculation. Units that commanded premium prices for their ocean views and resort amenities are being offered at discounts that would have been unthinkable just months ago. The psychology of the market has shifted completely, and once confident buyers are now paralyzed by uncertainty about where the bottom might be. Governor Green's administration found itself caught between competing pressures that seemed impossible to reconcile. On one side, desperate sellers and real estate professionals demanded immediate action to stabilize prices and restore confidence. On the other, potential buyers and local families argued that the correction was long overdue and that artificial support would only delay the inevitable reckoning. Every policy proposal seemed to create new problems while solving none of the underlying issues that had created this mess in the first place. The mechanics of the freeze became apparent as transaction data rolled in week after week. Properties that had been under contract suddenly saw deals fall apart at the last minute, often due to financing complications or buyer's remorse that kicked in during extended due diligence periods. Appraisals were coming in below contract prices, forcing renegotiations that frequently ended in cancellations. The smooth machinery of real estate transactions that had hummed along during the boom years was now grinding to a halt under the weight of uncertainty and shifting market dynamics. Insurance costs emerged as one of the hidden accelerants of the crisis. Policies that had been manageable during the good times suddenly spiked to levels that made ownership financially impossible for many buyers. The combination of climate risk assessments and recent natural disasters had fundamentally altered how insurers viewed Hawaiian properties, and the resulting premium increases were being passed directly to consumers who were already stretching to afford their purchases. For many potential buyers, the monthly insurance bill became larger than the mortgage payment itself. Local income levels, which had never really kept pace with the inflated housing costs of the boom years, became starkly inadequate as the market correction exposed the gap between what people earned and what they needed to afford island living. Families who had been priced out during the frenzy found that even with falling prices, home ownership remained out of reach due to tightened lending standards and increased carrying costs. The promise of the correction creating affordability was proving to be largely illusory for the residents who needed it most. The governor's inner circle struggled to craft a response that would address the immediate crisis without creating long-term distortions in the market. Traditional tools like tax incentives or first-time buyer programs seemed inadequate to deal with a problem of this magnitude. More aggressive interventions risked accusations of market manipulation and could potentially make the eventual recovery even more difficult. Every option carried political risks that extended far beyond real estate, touching on broader questions about government intervention and economic management. Construction projects that had been fast-tracked during the boom suddenly became liabilities as developers faced the reality of bringing new units to market in a collapsing environment. Permit applications that had sailed through approval processes now represented millions in sunk costs with no clear path to profitability. The pipeline of new supply that was supposed to ease the housing shortage instead became another source of downward pressure on prices, creating a vicious cycle that seemed to feed on itself. The ripple effects spread far beyond the real estate sector as the broader economy began to feel the impact of the housing market's sudden stop. Construction workers, real estate agents, mortgage brokers, and countless other professionals who had thrived during the boom found themselves facing reduced income or unemployment as transaction volume evaporated. Local businesses that had expanded to serve the influx of new residents and property investors suddenly found their customer base shrinking, creating secondary waves of economic distress throughout the community. International buyers, who had been a crucial source of demand during the peak years, began pulling back as word of the market's instability spread. The luxury segment, which had been insulated from many of the affordability concerns affecting local buyers, started showing signs of weakness as foreign investors reassessed their exposure to Hawaiian real estate. Properties that had commanded premium prices based on their appeal to international wealth suddenly found themselves competing in a much smaller and more price-sensitive pool of potential purchasers. The timing of the crisis created additional challenges for the governor's administration, coming as it did during a period when other economic pressures were already straining state and local budgets. Tourism, while still strong, was showing signs of volatility that made it difficult to predict revenue streams. The housing market's contribution to tax receipts, both through property taxes and transfer fees, had become a significant factor in budget planning, and its sudden decline created immediate fiscal pressures that required rapid adjustments to spending plans and revenue projections. As the situation continued to deteriorate, Governor Green faced mounting pressure to take decisive action, but the complexity of the crisis defied simple solutions. The market forces that had created the bubble were now working in reverse with equal intensity, and any intervention would need to account for multiple interconnected factors that seemed to resist traditional policy approaches. The governor's response would ultimately determine not just the trajectory of the real estate market, but the broader economic future of the islands and the political fate of his administration. Emergency sessions stretched late into the night as Governor Green's policy team scrambled to understand exactly what was happening beneath the surface. The numbers weren't just bad, they were unprecedented. Monthly sales figures that typically showed steady if modest activity had dropped to levels not seen since the immediate aftermath of major natural disasters. But this wasn't caused by a hurricane or volcanic eruption. This was a market collapse driven by forces that seemed to multiply and reinforce each other in ways that traditional economic models couldn't predict. The governor's housing task force found itself facing a puzzle with no clear solution. Every lever they considered pulling seemed connected to three others that might make the situation worse. Lowering property taxes could provide relief to struggling homeowners, but would devastate municipal budgets already strained by reduced transfer tax revenues. Relaxing building codes might speed construction and increase supply, but could undermine safety standards that voters demanded after recent mainland disasters. Creating buyer incentive programs might stimulate demand, but could also artificially prop up prices that many argued needed to fall further to reach sustainable levels. Behind the scenes, real estate professionals were painting an even grimmer picture than the official statistics suggested. Veteran agents who had weathered multiple market cycles described conditions they'd never encountered before. Open houses that once drew crowds of eager buyers now attracted only a handful of lookers, many of whom seemed more curious than serious about purchasing. The psychology of urgency that had driven the boom years had been replaced by a pervasive sense that waiting was the smartest strategy, creating a self-fulfilling prophecy of declining activity. The condo market's unique vulnerabilities became more apparent as the crisis deepened. Association dues that had seemed manageable during the appreciation years suddenly felt crushing when combined with falling property values. Special assessments for building maintenance and improvements, once easily absorbed by rising equity, now represented significant financial burdens for owners who were already underwater on their mortgages. The collective nature of condo ownership meant that individual financial stress quickly became building-wide problems that affected every unit's marketability. Short-term rental operators, who had been a significant driver of demand during the boom, found themselves caught in a particularly brutal squeeze. Properties purchased specifically for vacation rental income were generating far less revenue than projected as tourism patterns shifted and competition increased. Many owners discovered that their rental income couldn't cover the mortgage, insurance, and maintenance costs, forcing them to list properties for sale in an already saturated market. The flood of former rental units hitting the market added another layer of downward pressure on prices across all segments. Governor Green's administration faced intense scrutiny from multiple directions as the crisis deepened. Local residents who had been priced out during the boom demanded aggressive action to make housing affordable again, while property owners who had invested their life savings pleaded for measures to stabilize values. Mainland investors who had poured money into Hawaiian real estate during the peak years were threatening legal action if government policies further damaged their investments. The governor found himself trying to balance the interests of groups whose needs seemed fundamentally incompatible. The lending environment had transformed almost overnight from accommodating to restrictive. Banks that had eagerly written mortgages during the boom years were now requiring extensive strict documentation and imposed debt-to-income ratios that eliminated many potential buyers from consideration. Appraisals that had routinely come in at or above contract prices were now consistently falling short, forcing renegotiations that often led to deal cancellations. The credit that had lubricated the market during the good times had essentially dried up, leaving even qualified buyers struggling to secure financing. Construction crews that had been working overtime to meet demand during the peak years suddenly found themselves with nothing to do. Projects that had seemed like sure bets when ground was broken were now financial disasters as developers faced the reality of trying to sell units into a collapsing market. The construction industry's rapid scaling during the boom had created overcapacity that was now painfully obvious, with equipment sitting idle and skilled workers leaving the islands in search of opportunities elsewhere. The governor's economic advisors presented him with projections that ranged from cautiously pessimistic to catastrophically dire. The most optimistic scenarios suggested a gradual stabilization over several years, while the worst-case analyses predicted a complete collapse that could take a decade to recover from. The uncertainty itself became a factor in the market's decline, as potential buyers and sellers adopted wait-and-see attitudes that further reduced transaction volume and price discovery. Local media coverage intensified the crisis atmosphere as daily reports tracked falling prices and rising inventory levels. Stories of families losing their life savings or being forced to move to the mainland dominated news cycles, creating a narrative of economic catastrophe that became self-reinforcing. The governor's public appearances were increasingly dominated by questions about the housing market, forcing him to balance honesty about the severity of the situation with attempts to maintain confidence in the broader economy. Property management companies reported a surge in distressed sales and foreclosure proceedings, as owners who had over-leveraged during the boom found themselves unable to meet their obligations. The legal system became clogged with real estate disputes, short sales, and bankruptcy proceedings that further complicated an already chaotic market. Each foreclosure that hit the market represented another data point in the downward spiral, providing comparable sales that justified even lower valuations for similar properties. The vacation rental market, which had been a major economic driver for many communities, experienced its own parallel collapse. Properties that had commanded premium rates during peak seasons were now struggling to attract bookings at any price. The oversupply of rental units, combined with broader economic uncertainties affecting travel patterns, created a perfect storm that left many owners with negative cash flow properties they couldn't afford to keep, but couldn't sell at acceptable prices. Governor Green's administration realized they were facing more than just a real estate correction. This was a comprehensive economic restructuring that would reshape the island's economy for years to come. The question was no longer whether they could prevent the collapse, but whether they could manage its impact and position Hawaii for eventual recovery. Every decision carried enormous consequences, and time was running out to craft a response that might limit the damage. Federal emergency declarations became a real possibility, as Governor Green's team recognized the cascading effects were now threatening critical infrastructure and public services. Property tax revenues, which formed the backbone of municipal budgets across the islands, were projected to fall by margins that would force dramatic cuts to schools, emergency services, and basic maintenance. The math was unforgiving. When property values collapse, so does the tax base that funds everything from fire departments to road repairs. The Governor's Emergency Economic Council presented scenarios that kept him awake at night. Hospital systems that relied on property tax funding faced potential staffing cuts just as the economic stress was driving up demand for mental health services. Schools that had planned expansions based on boom-era revenue projections were now looking at classroom overcrowding and program eliminations. The housing crisis had metastasized into a full-scale threat to the island's ability to provide basic services to residents. Banking executives were quietly briefing the administration on exposure levels that made everyone in the room uncomfortable. Regional lenders who had written mortgages during the peak years were sitting on portfolios where significant percentages of borrowers were already underwater. The domino effect was predictable, as more homeowners found themselves owing more than their properties were worth. Strategic defaults would accelerate, putting additional pressure on an already fragile financial system. Commercial real estate, which had seemed insulated from the residential collapse, began showing its own warning signs. Retail spaces that had thrived on the spending of affluent homeowners and vacation rental guests started experiencing vacancy spikes. Restaurants, boutiques, and service businesses that had expanded during the boom discovered their customer base was evaporating along with property values. Strip malls that had commanded premium rents were now offering concessions just to keep tenants from walking away. The governor's polling numbers reflected the growing anxiety throughout the islands. Voters who had initially blamed mainland speculators and market forces for the boom were now holding local leadership accountable for the bust. Every town hall meeting became an exercise in damage control, as residents demanded explanations for how things had gone so wrong so quickly. The political calculus was becoming as treacherous as the economic one, with no clear path to solutions that wouldn't create new problems. International attention began focusing on Hawaii as a cautionary tale of unsustainable growth and market speculation. Financial media outlets were dispatching reporters to document the collapse, creating a narrative that further damaged the island's reputation as a stable investment destination. Each negative story became another factor, discouraging potential buyers and investors, accelerating the down Green was desperately trying to arrest. The constructionward spiral that Governor Industries' collapse was particularly visible and economically devastating. Cranes that had dotted skylines across the islands stood motionless over half-finished projects that developers couldn't afford to complete. Workers who had relocated from the mainland during the boom years were now facing unemployment in a market with no alternative opportunities. The ripple effects touched everything from equipment rental companies to building supply stores that had expanded to meet boom-era demand. insurance companies began reassessing their exposure to Hawaiian properties with a scrutiny that revealed uncomfortable truths about risk and pricing. Policies that had been written based on ever-rising property values now covered assets worth significantly less than their coverage amounts. The mismatch created systemic risks that extended far beyond individual homeowners to the broader insurance market's stability and pricing models. Governor Green's senior staff found themselves managing multiple crises simultaneously as the housing market's collapse triggered secondary effects across every sector of the economy. Tourism operators reported cancellations from potential visitors who were reconsidering expensive Hawaiian vacations amid their own financial stress. The hospitality industry, which had been a reliable economic anchor, was beginning to show signs of strain that could compound the housing market's problems. Local credit unions and community banks that had built their business models around serving island residents faced their own existential challenges. Loan portfolios that had looked conservative during the boom years were now revealing concentrations of risk that threatened institutional survival. The governor's team realized they might need to coordinate with federal regulators to prevent banking failures that could devastate communities already reeling from the housing collapse. Property developers who had been local success stories during the boom became cautionary tales almost overnight. Projects that had promised to deliver affordable housing for local families were now financially impossible to complete at price points anyone could afford. The irony was cruel. The market correction that was supposed to improve affordability had actually made housing less accessible by destroying the financing mechanisms that enabled construction. The vacation rental industry's implosion created its own set of cascading problems that the governor's team hadn't fully anticipated. Neighborhoods that had been transformed by short-term rental operations were now dealing with abandoned or underutilized properties that created maintenance and security issues. Homeowners associations faced budget crises as rental income that had supported common area maintenance disappeared, leaving permanent residents to shoulder costs they couldn't afford. Legislative leaders were pressuring Governor Green to call emergency sessions to address the crisis, but the proposed solutions ranged from inadequate to potentially counterproductive. Some lawmakers wanted aggressive market interventions that economists warned could distort price discovery and delay recovery. Others proposed austerity measures that would compound the economic pain by reducing government spending just when stimulus might be needed most. The psychological impact on island communities was becoming as significant as the financial damage. Families who had seen their neighborhoods transformed by rapid development during the boom were now watching those same areas become ghost towns, dotted with for-sale signs and empty units. The sense of community that had defined many areas was being eroded by the constant churn of distressed sales and departing residents. Governor Green's attempts to maintain public confidence were increasingly undermined by data that contradicted official optimism. Monthly reports showed continued deterioration across every metric that mattered. Sales volumes, median prices, construction permits, and employment figures all pointed in the same direction. The governor found himself in the impossible position of needing to acknowledge reality while trying to prevent panic that could accelerate the decline. The crisis was reshaping political alliances and priorities in ways that surprised veteran observers. Environmental groups that had opposed development during the boom were now concerned about the economic devastation affecting working families. Business leaders who had championed growth were calling for government intervention to stabilize markets. Traditional ideological positions were being scrambled by the severity of the situation and the lack of obvious solutions. Federal officials were beginning to take notice as the Hawaii situation developed implications for national housing policy and financial stability. The islands had become an extreme example of boom and bust cycles that were affecting markets across the country, making it a test case for policy responses that might be needed elsewhere. Governor Green found himself fielding calls from Washington as his local crisis attracted national attention and potential federal involvement. The governor's economic development team faced the impossible task of trying to attract new investment and economic activity while managing a collapsing real estate market. Every initiative seemed to conflict with market realities that made traditional development strategies obsolete. The tools that had worked during stable or growing markets were proving useless in an environment where fundamental assumptions about value and growth had been shattered. As weeks turned into months, Governor Green's administration realized they were not managing a temporary correction, but overseeing a fundamental transformation of Hawaii's economy. The boom years had created dependencies and expectations that were proving impossible to sustain, and the adjustment process was going to be longer and more painful than anyone had initially predicted. The question was no longer when the market would recover, but what it would look like when it finally stabilized. The Governor's Emergency Housing Summit convened behind closed doors as the full scope of the disaster became clear. Financial institutions were reporting loan delinquencies at levels that threatened their survival. Major developers who had been pillars of the community were quietly filing for bankruptcy protection. The carefully constructed narrative of sustainable growth was crumbling faster than anyone could manage the messaging. Real estate professionals who had built careers on the boom years found themselves facing an existential crisis. Agents who had earned six-figure commissions were now struggling to close a single deal per month. Brokerage firms that had expanded aggressively were shuttering offices and laying off staff who had no other marketable skills. The entire ecosystem that had grown around the housing frenzy was contracting at a pace that left thousands of workers scrambling for alternatives. Governor Green's policy advisors presented him with models that showed the crisis spreading beyond real estate into every corner of the island economy. Luxury car dealerships reported inventory sitting unsold as buyers who had leveraged their home equity for purchases during the boom could no longer access that wealth. High-end restaurants faced empty tables as the spending power that had driven the service economy evaporated along with property values. The demographic shifts were becoming visible in school enrollment data and voter registration records. Families who had moved to Hawaii during the peak years were now relocating to more affordable mainland markets. Young professionals who had planned to build careers in the islands were reconsidering their options as job opportunities disappeared and living costs remained stubbornly high despite the housing correction. The brain drain threatened to compound the economic damage by removing the human capital needed for eventual recovery. Municipal governments across the islands faced budget crises that made previous fiscal challenges look manageable. Property tax assessations were being era-valuements that had been based on boomed by property challenge owners who demanded reductions reflecting current market conditions. The legal battles over assessments created additional costs while reducing the revenue needed to fund basic services. Fire departments, police forces, and maintenance crews all faced potential cuts that would affect public safety and infrastructure quality. The vacation rental market's collapse created unique challenges that traditional housing policy hadn't anticipated. Neighborhoods that had been zoned for single-family residents but transformed by short-term rentals were now dealing with properties that couldn't generate rental income but were unsuitable for permanent residents due to years of intensive use and minimal maintenance. Homeowners associations struggled with enforcement issues and maintenance backlogs that threatened property values throughout entire communities. The collapse of Maui's condo market stands as a stark reminder that even paradise has its price. Governor Green's frantic attempts to contain the damage reveal the brutal reality facing every boom market. When speculation meets correction, the aftermath reshapes entire economies. For Hawaii, the question isn't whether recovery will come, but what form it will take when the dust finally settles.